Welcome to Integrating ESG in Stock Valuation. CLSA case study, ForgeCo, a long-standing player in the industrial sector, sought to enhance shareholder value through McKinsey's valuation framework. This strategic approach focused on identifying growth opportunities and optimizing resource allocation. By aligning operations with value creation principles, ForgeCo aimed to rejuvenate its market position and drive sustainable growth. ForgeCo faced a critical challenge in 2024. Despite stable revenue, shareholder value stagnated. The leadership recognized the need for a strategic shift. They realized that maintaining the status quo was insufficient, and a new mindset was essential to drive growth and enhance shareholder value. ForgeCo shifted from a traditional earnings focus, emphasizing quarterly results and earnings per share growth, to a strategy centered on long-term shareholder value and sustainable returns. This transformation involved adopting McKinsey's proven valuation framework to guide strategic decision-making, ensuring a focus on sustainable growth and enhanced shareholder value. McKinsey's valuation framework emphasizes shareholder value as the ultimate goal. It identifies 5 key value drivers as levers to impact value: return on invested capital, growth, weighted average cost of capital, competitive advantage period, and reinvestment rate. Strategic decisions and day-to-day operational choices are crucial in leveraging these drivers effectively. Return on invested capital, ROIC, assesses if earnings exceed capital costs. Growth focuses on expanding high ROIC operations. Weighted average cost of capital, WACC, evaluates if capital costs can be reduced through strategic finance. The competitive advantage period measures the duration of above-average returns. Reinvestment rate examines if capital is allocated effectively. Understanding the relationship between return on invested capital and weighted average. Cost of capital is crucial for value creation. When return on invested capital exceeds weighted average cost of capital, a company creates value. At break-even, where return on invested capital equals weighted average cost of capital, no value is created or destroyed. Conversely, if return on invested capital falls below weighted average cost of capital, value is destroyed. This dynamic is essential for strategic financial planning and investment decisions. In ForgeCo's diagnostic phase, we analyzed return on invested capital by business unit and product line, identifying value gaps and quantifying potential value creation opportunities. We mapped operational metrics to value creation and benchmarked against industry leaders to measure performance. This comprehensive analysis provided insights into areas needing improvement and potential growth, setting the stage for strategic capital allocation. ForgeCo strategically allocated capital by divesting 3 low-return manufacturing units, enhancing overall efficiency. They expanded the specialty components division, achieving a 22% return on invested capital. Working capital optimization was achieved by reducing inventory by 15% and improving accounts receivable turnover. Strategic acquisitions of smaller competitors with complementary offerings further strengthened their market position. The value creation journey began with a negative value spread of 1%, as return on invested capital was 9% against a weighted average cost of capital of 10%. Through portfolio restructuring, strategic investments, and operational improvements, return on invested capital increased to 11% in 6 months, surpassing a weighted average cost of capital of 9.5%. After 1 year, return on invested capital reached 14%, with a value spread of plus 5%. The financial impact of our strategy is evident, with a 42% increase in share price within 18 months. The return on invested capital minus weighted average cost of capital spread improved to 5%, placing us firmly in the positive value creation zone. Annual free cash flow surged to $50 million, up from $120 million, highlighting the success of our strategic shift. Adopting a valuation mindset is crucial for leaders, as it transcends finance, shaping strategic decisions. Growth must surpass the cost of capital to truly add value. Focusing solely on earnings per share can be detrimental, risking long-term value. Disciplined capital allocation remains a chief executive officer's strongest tool for sustainable success. Analyze value drivers by breaking down your business into key components. Identify metrics that impact return on invested capital. Segment your portfolio by classifying business units based on return on invested capital versus weighted average cost of capital, and develop strategic roadmaps. Initiate projects targeting high-potential areas with clear value improvement targets. Regularly monitor metrics and establish feedback loops for continuous enhancement. Addressing common implementation challenges is crucial. Educate investors on the value creation journey to mitigate short-term earnings pressure. Communicate clearly about value destruction to overcome resistance to divesting legacy businesses. Use simplified dashboards with leading indicators to tackle return on invested capital measurement complexity. Enhance financial literacy through executive training on value driver concepts. Conduct a value diagnostic to identify your current return on invested capital, weighted average cost of capital spread, and key improvement areas. Ensure leadership alignment by educating your executive team on value-based management principles. Realign your strategic planning process around value creation metrics to drive sustainable growth. Thank you, and explore Skilled MBA's resources to enhance value-driven management. Access financial models, valuation templates, and strategy blueprints tailored for your organization. For assistance, contact us at +91 87553 0795 or support skilledmba.com. Visit our website at https://skilledmba.com for more information.